subscribe now and press the bell icon. Never miss an update.
So that's what we worked upon, self-employment deduction. The first one is self-employment tax. Okay, just tell me how much is self-employment taxes? Okay, so we already went through it. I think we have covered health insurance deduction. Yes, they can deduct 100% of the payment. Good job, Devyansh. Now we'll quickly focus on the retirement plans. Okay, when it's called self-employed SEP, simple SIMPLE, and qualified plans, they all SEP, simple and all, they all are acronyms that stand for something related to retirement plans. So in general, retirement plans are deductible, as a tax deduction. You can reduce your taxable income. So, and these ones are the plans which are given for self-employed people. Because self-employed, obviously, as the name suggests, they don't have an employer. They are employing themselves. They are running a business and they're supporting themselves. So IRS says that, okay, we'll give you some, more plans, more choices, so that you can also put in the money as the other employees do through their 401k. And because you're running your own business and all, there are obviously certain more, privileges that you can get as far as deductions are considered. So SEP stands for Self-Employment Retirement Plan, and there is a maximum amount of $56,000 that one can claim as a deduction. And how this is done and all. So if you have worked on the matching that we do for few of our clients, we have to take 25% of the total payroll compensation, and that is something that the business can also put in towards employees' retirement plan. So we are not going to get too much into detail like here, but what we need to know is that different kind of plans and the maximum that they can take. Now this 56,000 must have increased to 60,000 or something, but yeah, there is a good amount of retirement saving one can do if it's all structured properly, and we have done that for a lot of clients. So they can put in as much as $56,000 per person. So if both husband and wife are running the business and both of them are employees, it can go up to $100,000 plus. And that's a very, very big saving. But the benefits have to be given to everyone. So if they are planning to hire more employees, then this is not going to be beneficial plan for them. So we try to tell them that just have two of you, just husband and wife and all, because for all US purpose, husband, wife, we know they're treated as same. They file joint returns, so all their income comes into the same, form and all. So this limit, they both can be the people on the payroll, and each one of them can enjoy so much of savings. That's a very, very common plan, and it gives a lot of tax benefits. And this is in top of what they themselves can put in. So as an individual, one can put in up to $20,000. We see that from 401k, right? That's something most of us should know. Because when we are doing W2s, when we are looking into W2s, that time also we'll see 401k amount. So they are putting from their paycheck, they are putting some amount in 401k. But if they are self-employed, the business can also do a match, and business can also say that, okay, for these employees, the business will also put in certain amount. And that could be a very big saving because the limit is very high, $56,000 per person. Okay, so but it should not lead them into losses. That's one of the conditions, that after putting into this money, if they are like eating up all their profits, or if the business gets into a loss situation, then it's not allowed. Okay, and we have also seen that the self-employment taxes are deductible, half of them. Not full 15%, but half of them are deductible. I think there is we can go through this simple example here. So anyways, let's just look into this point. This could be a bit confusing. Don't try to understand, but if you're not able to understand, it's fine. Don't put too much stress on that. What they're saying is contribution to the plan are subtracted from net earnings to calculate self-employed earnings. So we have to calculate self-employed earnings. But that 25% has to be taken on the self-employment earnings before the contribution to the plan. Okay, before the contribution, because how would we know? When we know this is the self-employment earning, we'll take 25%. Then you reduce that amount to come up to the net self-employment earnings. And self-employment taxes are calculated on that. So what they're saying is this is going to lead to circular computation. Okay, sometimes a lot of times we get stuck into Excel, right? There's a circular formula error and all. So what they're saying, instead of using 25%, if you want to go with the net amount, just use standard 20%. Otherwise, on the gross, it's going to be 25. Let's just look into one quick example here. Maybe last time we did that. If the earnings are $100,000, 15% is self-employment taxes. So these are $15,000 is self-employment taxes. Now, this $15,000, 50% of that will reduce the taxable income. So 50% of this will come to 7,500, and this income gets reduced, and that's where we like on the above the line adjustment where it says net self-employment taxes deduction, we will put this amount 7,500 because we get deduction only for 50%. Okay, so this is a little bit of benefit that IRS has given. Instead of taxing income of $100,000, what they're saying is, income tax is never deductible, right? We know that if somebody is earning $100,000, they're paying 20% taxes. So $20,000 they're paying as taxes. They cannot go to IRS and says, well, I'm paying $20,000 as taxes. So give me that as a deduction. So basically my income is only $80,000. That's not allowed. The taxes are never deductible, but this is self-employment taxes. So what IRS is saying, you can take deduction for 50%. This is not income tax. They have a self-employment retirement plan, SEP plan. Okay, we already saw what is SEP. So the limit is 25%. The maximum that you can go is 56,000. So what they're saying is the self-employment earning is $100,000, but she already has an employee and she's paying $20,000 to that employee. So maximum 25% of that, which will come to $5,000, can be put up in the retirement plan for that employee from Diana's clothing store. That's her business. So obviously Diana herself is not putting in, the business is doing all that. So what they're saying, up to 25% you can put it. If let's say if the employee gets like $300,000-$400,000, then the 25% will come to very big amount. Say $400,000, 25% will be 100,000. In that case, this limit will come up that you cannot go above so much. Okay, so what they're saying is, and now they're talking about this circular computation that we see, that instead of like, we know that self-employment earnings is $125,000. Out of that, the deductible part of self-employment taxes is $9,563. So if you're taking 25%, then we need to take 25% on this much amount. Otherwise, what IRS is saying, to make it simple, for convenience, you just use standard rate of 20% after the deduction. So 125 minus this 9563, and you just take 20%. This is again SEP, qualified plan deduction. For SEP, the limit is 25% only. Okay, but the self-employment taxes can be deducted. Now, this is going to lead to a loop if we put in this formula like this. So what IRS is saying, don't worry about that. 25% is on 125,000. But you want to deduct your taxes also, then you deduct it and you take 20%. Because the taxes are also deductible. So for the purpose of convenience, just do this kind of calculation. Again, when we are doing if the software is doing all these things, we are not manually putting in any formula and all. What we need to learn from here is, if a client comes and asks us that I'm planning to open a company, I'm gonna have so much of, say, $500,000 of revenue in first year, or $200,000. How can you advise something on how can we save most of it? We should be able to think that, okay, why don't you guys set up a payroll? If there is no need to hire anybody else, just you and your spouse can come on the payroll, and we can maximize your contributions to retirement plan. Any money that you put into retirement plan will be tax deferred. So it's pretty much possible that on an earning of $200,000, 100,000 straight away goes out as tax free, and they're paying taxes on only $100,000. But if they don't put up all these plans and all, just imagine their tax liability is going to be double. So we need to know about what different kind of plan, and these are all possible only if the person is self-employed. If the person is an employee, we just have to go with the plans that employer is providing. We don't have that flexibility. We cannot go and tell that, okay, change the plan for me, give me this, give me that, because employer is going to have a lot of other employees. They want to have a standard practice. They cannot keep changing their rules and all. So this is a very, very important tool. Lot of times we have seen that in the case of lot of our clients, we created S corporation for them. Why did we create? So that we can run the payroll. Why do we want to run the payroll? So that we can put this entire 25% in the retirement plan. Okay, that's a big saving. Another one is called SIMPLE, Savings Incentive Match Plan and all. This is called Simple. This is there the limit is very low, only $13,000 could have been put in. Now it could be 15, whatever, but it's very low as compared to SEP. An employer can match up to 3%. And it may be deducted as an above the line deduction. So employer can also do up to 3% of the self-employment earnings. It's not 3% of what they are putting in the contribution plan, or not 3% of the payroll which is being run. 3% of self-employment earnings, so it could come to a significant amount. But employee can put in only up to $13,000. Usually with 401k, they can put in up to 20,000 and all. But see, if there are a lot of other employees and all, and they don't want to go with this high saving plan and given a very big contribution for everybody, then they can go for this plan, and they say that, okay, we'll still do 3% of the savings and all those things, 3% of the match and all. So we have another client where we are using this plan. And Tanya, you should be knowing, or maybe Vinita should be knowing. She's the one who's working on that. Okay. Any questions so far on these retirement plans? We need to remember, in US, retirement is a big tax saving. It's not like PF or PPF here where you just put in 1 lakh or 1,50,000. That's it, you're done. That doesn't even count. If a person is having an income of 1 CR or 70, 80 lakhs and all, how much difference does it make? 1.5 lakhs, nothing. But in US, like if the person is making $100,000, he can easily put in up to 21,000, 22,000. So that comes to almost 25% of reduction in the taxable income. Okay, so that could be, in fact, by using this plan, SEP, we can make the entire self-employment earning to go to zero level. Everything can be pushed into retirement plan, and practically we can have zero taxes, a very small amount of taxes to be paid to IRS. What they say is that it should just not become negative. So make it like work in a way that it comes to the profits come only $1,000, $2,000, $3,000 in the net. So we are still satisfying all the condition at the same time, like, just eliminating all the tax liability. Okay, now I think we are all clear on that. And now we're going to start with alimony. We have already talked about it in our previous discussions in the previous chapter. I'm not going to spend too much time on that. Two reasons. One is that it's not even important in current scenario. There's no alimony deduction available. There's no alimony will not come up as taxable amount. Okay, so it's really not that important, but we still need to know if there's something which has happened in 2018, if and the alimony or child support has been decided, then how does that come up on 1040? So the rules explain they apply only to pre-2019 separations only. Okay, so this is not, it has been completely removed now. Before that, we know it was taxable, and if it is taxable, then the other person who is paying alimony can take a deduction as well. There are certain conditions, obviously, that if the husband and wife, they're living in the same house, they cannot be considered as separated. So they must not be the members of the same house. They must not file joint returns. They must so it's not like just on papers you're doing something. It has to be a real separation, right? That's what IRS is trying to say. Now, if they have a jointly owned home, how do they split up the payments? Because as we saw in US, most of the properties will be jointly owned. So if the instrument, whatever the divorce instrument or the agreement, if they states that the taxpayer must pay expenses for a home owned by taxpayer, if it's saying that one person has to pay, but it is owned by both of them, then the other person gets benefit. Right? If it says in the agreement that only husband has to pay for all the mortgage payments, but wife is also the owner, then she gets the benefit. It is considered as a kind of alimony. That's what they're saying. It doesn't have to be named as an alimony. We have to get deeper into it, and we have to see any kind of benefits that is passed on from one spouse to the other can be considered as an alimony. Okay, especially if both of them are supposed to pay, but one of them is not paying and the other is paying on behalf of both, then it's a benefit that the other person gets, so it can be considered as alimony. Jointly owned home and all, then typically, if it's jointly owned home, then one half of the payments have to be considered as alimony if one spouse is paying all of them. Again, same thing with taxes and insurance and all. So what we can do is we can just quickly go over this table. There's something called tenants in common in US. One is the joint ownership. We all know what is joint ownership, right? That's a very common concept and all. So if the house or a property is jointly owned, then half of the total payments can be split up between husband and wife. And the taxpayer can claim as an itemized deduction, whatever half of the expense and all. Itemized, why are they saying itemized only for interest? Because only interest can be claimed as itemized deduction. We have already gone through Schedule A and itemized and all. We know that repayment of principal is not going to give any deduction. It's only the interest that we are paying will be deductible. And if it is tenants in common, or if it's tenants by the entirety or joint tenancy, now these are different concepts. This is legally, they're different than joint ownership. Now what does that mean? That means that maybe they're holding more in the capacity of partners, not joint ownership. So each one of them are having their own ownership in the property. But let's say if one of the spouse dies, typically what happens, the other spouse gets the full ownership. That's not the case in tenants in common or joint tenancy and all. If one of them die, then it goes to the heir of that person. So maybe they're separated, they can still be tenants in common, or it can go to the state of that person and all those things. So we need to see how they are holding it. And based on that, their tax treatment can be different. Okay, and that's so what they're saying is what can be deducted if held as tenants by the entirety or in joint tenancy, none of the payments the taxpayer can deduct and a spouse must include none of the payments. None of the payments for real estate taxes and home insurance. Those mortgage payments and interest and all, they'll still go with this same rule. This could be a bit complicated thing. We're not going to spend like too much time here because I don't see any, even if we go a bit in detail, it could be, it's not practically very important. All we need to know is if they are separated and all, then if they both of them are still the owners of the property, which person is making the payment and which person is claiming it. Technically, both of them can claim half of it, even if the payment is made only by one person. But if they have an agreement saying something else, then they have to follow that. Okay. Child support, again, child support. Sometimes they don't call child support separately. Sometimes it will be like, okay, pay alimony of $1,000 or $2,000 a year, sorry, a month. But there might be a clause in there that, out of that $2,000, say $500 towards child and all those things. Or maybe if the child turns 18 or 21, then the alimony gets reduced to $1,500. If there is some kind of link to child support, okay, then we have to separate out those payments because child support is not deductible. Alimony has a different treatment, child support has a different treatment. We'll just go through this example. Alimony recapture, again, we have already done that. Does anyone remember? When does the recapture comes into the picture?
Like amounts of alimony reduces or increases in further years.
Who do you think
So
reduces or
practically,
increases? Stick with one thing. Sakshi, is that you?
yes, ma'am.
Hmm. What happens? Put in the logic now. Don't try to remember, like, don't try to mug it up. What is the logic there?
Mm, I don't remember.
At least you're
It
close to
reduces, ma'am.
hmm?
The amount reduces in
Exactly.
second
The
or
amount is
third
very
year.
high earlier in the earlier years, and then it gets reduced. So
Yes, ma'am.
what they're trying to do is they're trying to just push out the property or do some transfers by way of alimony because it can be deductible, okay, in the previous years. So that's why they have this alimony recapture. Recapture occurs if payments significantly decrease in second or third year. Okay, if it's the uniform payment, it doesn't matter. So, but anyways, good try, Sakshi. I was kind of hoping at least you will give the answer. We have done that. We have done this example, same example we have done. So, we can just quickly go over it. But Sakshi, can you read this? 4.4.
Stephen and Chelsea were divorced in 2018 and agreed that Chelsea would pay Stephen $4,500 as a part of the divorce agreement. These payments are to be made in cash and discontinued upon Stephen's death. Because the two no longer live together and do not file a joint return, these amounts would typically be treated as alimony. However, an additional provision states that $1,000 of the payment will stop upon their son Daniel reaching age 18. Accordingly, this amount is presumed to be child support and only $3,500 of the payment is deductible as alimony. Additionally, for divorces after 2018, alimony payments are not deductible by the payer or includable in income of payee. If these two taxpayers wanted to switch to the newer treatment, the modification of pre-2019 divorce must expressly provide for a non-taxability in order to be excluded from the payee's income and
Yeah.
non-deductible by the payer.
Right. So what they're saying, the whole point of this example is the agreement says that they have to pay 4,500 as part of the alimony, but there's a clause there that $1,000 will stop. So the payment will get reduced by $1,000 if there's whenever their son reaches age 18. So that clearly tells that out of this 4,500, $1,000 is for support for the son. That has to be treated as child support. Okay, so that's what they're trying to say. We have to make a distinction. Why? Because they both get different tax treatment. And recapture thing, again, I don't think I should spend time doing this thing because we've already done that before. We don't want to put in any more time. But what you need to see is the first year Lisa paid 60,000. Second year she's paying $40,000. Third year she's paying $10,000 as alimony. Clearly, there is a pattern here that it is decreasing, and it is decreasing significantly. Between 60,000 is just becoming $10,000. It's not like 60,000 then it becomes 58, 55, and all this. Clear thing that there is some other agreement between both of them that okay, as in the face in the name of alimony, we're gonna push out property from one person to the other. So that's why IRS prepared this rule that if this is what your guys are doing, then we have to do something called alimony recapture and use these formulas, come up with certain amount that will be considered as taxable, so that the amounts, at least the taxability happens uniformly. That's what the aim is. It should not that in the year $60,000 everything is taxable, and year third. Year one, 60,000 is taxable. Year third, only 10,000 is taxable. So IRS is like not getting consistent revenues. Alimonies are supposed to be consistent. So they're saying, fine, you can pay whatever you want, whichever way you want. But now when you're talking about the tax treatment, we'll do our own calculations and we'll try to uniform it. We'll try to make it uniform. Okay. So clear now, we have done this before. Is the repetition of the same topic. So this is a very important chapter, retirement. IRA is something we very frequently talk about. IRA is like individual retirement contributions or savings. This is for individuals only. Okay, and then there is a deduction for it. So that's why it becomes important. Right now, as we go ahead with our tax season, there will be many clients will come and they'll ask us, can I put money into IRA? Will it give me any benefit? So there are certain rules, there are certain limits that people earning below certain amount will get benefits. Obviously, high earners will not get that. So we'll have to probably run their numbers and tell them, because if they want to put in the money, they have a deadline of April 15th. If they want to put money into IRA for year 2022, they can do it only until April 15th. So before that, we need to be able to run their estimates and tell them whether it's beneficial for them or not. What is the point of putting money when they're not getting any benefit? Plus, because the money is also stuck there, they cannot take it out until they reach retirement age. And if they take out before that, it's not just taxable, there's additional 10% penalty on that. Okay. So this is what the limit is that they're talking about, the limits here, that if the person is single, head of household, then the AGI. Again, see, AGI is important. All the limits are based on AGI. If the income is below certain level or between certain level or whatever, accordingly they'll get deduction. Full deduction, maybe here it will be partial deduction. If the income increases above 74, there's no deduction at all. And this is for this category, single or HOH. For other categories, there might be other slabs. Again, we are not going to worry too much about remembering these amounts, because when you use the software, you put in there, it will tell you whether it is going to be a deductible amount or not. The point of going through all of that is you don't get confused that why, one of the client, oh yeah, they're getting like $2,000 back if I put money into IRA. The tax liability is getting reduced by 2,000, but for this client, nothing is happening. Don't think it's a software error. Okay, don't think there is a glitch in the software. It's probably that the limits are higher. Something is, something is there which is not satisfying this condition. Okay, so these are all the phase out limits. And yeah, so there are two things. Again, if the person is covered by a retirement plan, that means if the taxpayer is putting money into 401k, then the limits are different for them. Reason, because they're already being given this facility of putting money through the employer. A lot of employers do not provide 401k plans. What should the taxpayers do? Like, they still have a right to put money into retirement. So IRS is saying it's fine if your employer is not providing, you can still go ahead and put money into some other retirement schemes where you can directly go to the bank, open an account with them. It's like Provident Fund or something else. You go and you open an account and you tell them, I want to put money for my retirement. Okay, and then you let the IRS know that I've already put this money, so give me a tax break on that. But the phase out limits are different. If the following table is a summary of the modified AGI and deduction if covered by a retirement plan at work, if not covered by a retirement plan at work, or if just one of the spouse is covered. Okay, that also could be the combination, because we are, maybe one spouse is covered, the other is not covered. So that's why it's very important when we are entering the W-2, there is a very small checkbox there which says retirement plan. If you mark it, if you check that box, at least the software knows that, okay, the person is covered by retirement plan. So the limits get changed. But if you're not paying attention, we just take W-2, we just say that, okay, just box 3-4 box, you just fill them up with the numbers, and anyway, that checkbox is so small. Maybe we don't pay attention, we don't check it, the entire calculations will go, haywire, and then we'll definitely get a notice from IRS. But when we are getting W-2, 1099, any of the forms, it's very important to go very, very, slowly, very gradually look into each and every line item with full attention and see what is marked, what is not marked. Because by missing one checkbox, we can completely prepare a return which is going to be, which could be 100% wrong. Or unnecessarily, it will trigger something with IRS, and they may get a notice, or they may get an audit. All kind of trouble can be avoided if we pay attention to those forms. If the individual has reached certain age, then the limits change. That is the reason we always put date of birth. So please try to put the correct date of birth. The date of birth format is different for US. We put month first and then day and then year. So if it's January 3rd, you have to put it as 1/3, not 3/1. A lot of times I see that, that mistake has been done. 1331 will not make any difference. But if you put 15/3, the software will tell you there is no 15th month. The month gets ended at 12. There you may get an error. But if you put 13 or 31, software doesn't even know. So it will not even throw an error. And we will not be able to ever find out that there is a mistake which is being done. Okay, and this mistake may continue for years and years. Why? Because we are again rolling forward the file. We are not checking these basic information every year. We are just like rolling it forward. So the same mistake which was done last year get carried forward to next year. So let's pay attention to all those small details. Let's just finish up this thing. Then we already talked about there is a 10% penalty, but there are certain exceptions. IRS also realizes, US government realizes that there can be hardships in the life. There can be a medical emergency. There can be a need for education. There can be something else which gives the flexibility to taxpayer to withdraw the money before they reach retirement age. And the COVID year was one of the year where they have given an exception that if you've lost your job, if your income is drastically gone down or whatever, if you want to withdraw your retirement funds, please withdraw. We will not be charging any 10% penalty. But there are certain conditions for it. It's not just like, your income has doubled up in COVID and still you're going and withdrawing. That may lead to certain issues because that's not the intention. So to pay medical expenses or to for the qualified first time home buyers, home is like said to be an essential place, and like one should have their own home and all. So for those kind of things they have given an exception. Bhavani, 4.7.
Sonja, a 35-year-old CPA, recently withdrew $5,000 from her IRA established in 2013 in order to cover expenses related to purchasing her first home. Because this distribution qualifies as an exception to the general rules on early withdrawal, Sonja will not owe the 10% penalty tax.
Correct. So if a client comes and asks us that, I really need this money. I have some $50,000 in my IRA. Can I withdraw this? What is going to be the tax impact and all? We should ask, like, what are you withdrawing it for? If there is a medical expense that you want to pay, or if you're buying home for the first time, okay, then IRS will give some relief. Or if you're sending your kids for education and you don't have funds and you need to pay for their college fees or whatever, only qualified higher education, not school education. Why? Because school education is free in US. There are very, very good public schools which have no issues at all. So just because you want to send your kid to private school and claim this as a deduction, that's not allowed. Because anyways, if you can afford to send them to private school, that means you are earning quite well in US. Because 90%, 95% of the kids will go to public schools only. But colleges are not public colleges, right? The colleges, higher education, they always have to pay. So if you are taking it out for yourself or some relatives, whatever mentioned, then they are also not subject to 10% penalty. Hemant, can you close on this?
Jeremy withdrew 100K from his IRA upon reaching age of 50 in order to take a vacation to.
Wow, he wants to take a vacation with his retirement fund. Yeah, I really want to meet this guy, Jeremy. Go ahead.
Because this is not special exception. Premature distribution rule. German will be subjected to be 10% penalty tax of 10,000K in additional regular tax of distribution.
Correct, because there will be a penalty. Obviously, this is not the reason given by IRS. This is not a basic necessity and all. Okay, so if no questions, we'll close on it. Or if you have any question, comment, suggestion. If not, give the like thing and then we'll close on it.